So I was thinking, and Matt and I were thinking just this morning, that we really need a slide to show how auto trading works, and realized that we didn't really know how to put it together simply, and it was going to be too ugly of a slide once we created a Google slide. So we asked our brilliant team of developers for someone to sketch out how it works, and Dave sketched it out in minutes, and this is literally what he sent us, and we thought it was perfect. So on the left, just at a very high level, we have sophisticated software that captures price data for price action, events. So think of in terms of, is it jobs report day, is CPI report day, is it the Fed day, and so on. We track, I don't know the exact number, but 30, 40, 50 different events. We also track a massive database of, the dev team calls them features, or I think of like factors or indicators, but over 750 different criteria that can describe a market condition. And they go into a massive database. So we track all that data every single day. And then we have a separate repository of our algorithms. Our algorithms are what utilize the data to identify if an attractive statistical edge is setting up that day that could be traded within our risk tolerances. And we have pattern-based algorithms or strategies, event-based strategies, and we have machine learning-based strategies and algorithms. So different sort of sources of edge, if you want to think of it that way, that do, whether it be mean reversion or momentum trades, longs or shorts, a whole host of different types of trades that can occur and do occur inside of clients' accounts. All these different potential trades get fed into another layer that's our program layer. And we have, as you know, 4 programs, and those programs take all those different strategies and feed it into our risk management algos. And our risk management will literally segment each program's strategies for the day another level to make sure that we don't exceed the daily risk budget, as we call it, for a given program, right? Because we just can't take unlimited risk every day, because we will blow up your accounts and our accounts. So we have to have a certain amount of maximum acceptable amount of risk that we're willing to wager, if you will, that day. And then once the risk management filter kicks in, what's left are just the signals that will be traded that day. And those are sent algorithmically, electronically, and literally in milliseconds from our signal server co-located with the exchange in Chicago, Illinois, where the futures are traded, directly to our brokers. The brokers are spread out, but our primary broker is in Chicago, to a piece of software they have that receives our signals and converts them into orders for a giant allocation account that trades hundreds of clients' accounts simultaneously with hundreds, potentially thousands of contracts at a time, where the results are then segmented into trades and allocated to each client account for each program. So obviously we have more than 3 client accounts, but they get separated at the end of the day, and they do something called, I always screw this up, it's either ASP or APS, but it's average price sold, I believe is the name of it, where basically they have algorithms on their end that make sure that every single client account got the exact same result. And that, my friends, is how auto trading works. Next slide, please.
Hey, Scott, one question here, which is probably relevant.
Sure.
Is the neutral network consistently incorporating new data and walking forward?
You broke up in the very first part of, is the what network?
Is the neutral network consistently incorporating new data, learning and walking forward with that new data?
Yes. So we'll get to that in a little bit, but I'll answer it at a high level. We have 2 generations of machine learning that drive and create the majority of all of our edges, the vast majority of all of our edges. They are, every day they're updated with current price action and review their own performance as well for the current market conditions, and always adapting. So if it doesn't meet performance criteria, it will not take the trade. So we used to, for example, our algos used to automatically generate many mean reversion strategies, where we go the opposite direction of the prevailing trend at the open. So if the market's rallying into the open, it'd often sell, or vice versa, it would buy, because that was a really good setup in certain scenarios. The algos would adapt, would identify that and execute those trades for us. But now we do actually more. This may have changed this past year, but at the end of last year, I know that we were doing more follow opportunities where we were literally trading in the direction of the gap, because for the past 5 or 10 years, that bias that used to exist around 2005 to say 2012 changed to as QE came on board and everything just was, all the buy programs were kicking in and it just stopped working. So completely adapted. We didn't change a single thing on its own. And then with the machine learning, the second generation that we do now, they are being retrained regularly with new data and creating new results on a regular basis. So very, very adaptive. That's the key. That's what we raised over $3 million for, frankly, from shareholders to build out that infrastructure. That's why we contracted with Duke Center for Quantitative Modeling to get their assistance. And I'm going back several years. This isn't new stuff either. We've been second generation. We just finished after a 2-year project, but the first generation was built in around 2013 through 2015. So yes, sorry for the long-winded answer, but it's a great question. And frankly, that's why I think our results are more consistent than most others for sure in the industry.